Everyone, please try to be on video because that will make it more enriching for everyone. Yes. So you can tell when you will start. I will start recording them.
Okay. So, is everyone joining so that I can start?
Yes, sir. I think everyone has joined. They are not putting on video, so we are not getting to know. But by seeing the strength, I am feeling everyone has joined.
Okay.
You can start.
Yeah, no problem. Okay. So, today we start from effective annual percentage rate. Okay. So,
Yes.
like if it is annual, then it is easy to calculate, no issue. Okay. But if you in question, you will get 2.5% per quarter per quarter. In that situation, you need to use this formula. Okay. So what this formula said, effective annual interest rate, effective annual interest rate, which is basically 1 plus interest rate, means annual interest rate, divided by period in a year. Okay, so say for if we are compounding quarterly, then it is basically the 4. If we are compounding 6 monthly, then you need to consider the 2, like this, and then rest to the power p. So that is basically the formula for -1. Okay, so that is basically the formula for calculation of the effective annual interest rate. Okay, so here I is basically the annual stated interest rate. Okay, and because like you are paying the interest on a quarterly basis, so that's why you need to use this formula. Okay, we can take an example. I think it is given here as well. Yeah. So a note has an 8% stated rate of interest computed semi-annually, means 2 times per year. Okay, so how we need to calculate? Okay, so effective annual interest rate, okay, this is basically bracket 1 plus 8% divide by 2 bracket complete. Okay, then entire bracket complete, rest to the power 2 and -1. So it is somewhere, just a minute. Oh, 1 plus yes 8 divided by 2 square. Okay, -1 actually go here. It is 25. Huh? So 1.08. It is basically the 8%. Okay, and then -1. Okay, so this is 8.16%. Okay, are you able to understand what I when I simply put the 8, so that's why the number is wrong. Okay, either you need to consider the 8% or 0.08 like this. So you will get 8.6%. Okay, so this way you need to calculate. If it is compounded quarterly, then like the formula is everything is same. Instead of 2, it is 4. And here also 4. So it is basically 8.24 because you are getting interest on the interest. Okay, so that's why. So here, I mean, in earlier question, if you see, we calculate with respect to the amount. Okay, in this question, we are calculating by considering only interest rate. Okay, so that is basically the difference. Any doubt here? Means what is the difference here and here? Here we calculated on the basis of amount, and there is a a fund which we got to utilize for the operational activities. Okay, with respect to that, that we calculate from stated interest rate to effective annual interest rate, and here we are just using the effective annual rate, annual interest, stated interest rate to calculate the effective annual interest rate. So this mechanism you cannot utilize when there is a compensating balances or when there is a bank charges. Okay, but the first one you can utilize when there is a compensating balances and when there is a bank charges. Are you able to get me what is the difference in these two methods?
Yes, sir.
Yes, sir.
Then simple interest, it is basically the simple calculation. Simple interest is basically principal at the start of the year multiplied by interest rate and multiplied by the period, time period. So here, like 10,000 promissory note bears a simple interest at 8% for 2 years. So 10,000 multiplied by 8% multiplied by 2 years. So 8% of 10,000 is somewhere 800 multiplied by 2 equals to 1,600. Okay, so this way we need to calculate the simple interest. Simple interest is easy. The compound interest, so it is again like P0 is same because we are calculating on the principal at the beginning of the year multiplied by 1 plus I raised to the power n. Okay, that is basically means the number of period. Okay, so here if it is quarterly or something like that, so then again 1 plus I multiplied by divide by the number of quarter. I am just denoting with k, number of period, frequency, and here k multiplied by n. This is basically the formula. When there is a quarterly compounded or 6 monthly compounded. Okay, so in that situation we need to calculate like this. So problem here again, 10,000 carries an interest rate of 8% for 2 years. Now you can understand. Okay. P0 is 10,000. I is 8%. Okay, n means period is basically the 2 years. Okay, so what is our formula? This multiplied by bracket 1 plus this percentage multiplied by this one. So this is 11,664. This is basically the future value. So interest amount is 1664. Means interest is basically, after that here it is minus P. So again principal we need to reduce. Okay, so 1664 is compounded interest. Okay, if it is quarterly compound, so I'm just write K and the four quarter in a year. Okay, so this become like this. This divide by this. Again, here also we need to create a bracket and multiplied by this. So it is 1764. 1716. Okay, and okay, I just because we need to keep the, okay, 1664, and if you see the slightly higher amount because we are paying quarterly compounded. Okay, so we are recalculating the principal amount at the end of every quarter. So that's why we are means if there is a quarterly compounded as compared to yearly compounded, we can get the higher interest amount. Okay, any doubt here? Then required rate of return. Okay, so required rate of return is basically means what the investor expecting the return on his investment. Okay, so I mean there are certain terminology which we need to see. One is maturity risk premium is the compensation that investor demand for exposure to interest risk over a time. This risk increases with time to maturity. Just take an example. Maturity risk premium. Okay, if I invest for 2 years and if I invest for 10 years, okay, so what would be the interest rate investor is expecting if he invest for 2 years, and what would be the interest rate investor is expecting if he is invested for 10 years? Just imagine if we keep an FD with the bank for a 3 month to 1 year time, and if you keep a FD with the bank for a 4 years, 5 years, 10 years. Okay, so what variation you will find in a interest rate bank is offering to you on your deposit amount? Any guess?
Might be slightly higher.
For 10-year period or 2-year period?
10-year period.
Yes. Okay. So it is higher. Why it is higher? Because you can project the 2-year situation, but you cannot project the 10-year situation. Okay. So the investor is taking a risk. Okay. And that's why he expects additional risk premium over and above the market rate of interest. Okay. So it is basically the compensation that investor demand for exposure to interest rate risk over a period of time. Okay. So here the interest rate is high for the 10-year. Then purchasing power risk or inflation premium. Inflation premium. Okay. So it is basically the compensation investor required to bear the risk that price level will change and affect asset value or the purchasing power of invested dollar. Okay. See what happened if I consider the 7% as a inflation rate. Okay. So whatever may be the value for the $100, okay, after 1 year it become 100 divided by 107%. Okay, so what is that amount? So it is 93, and here it is 100. Okay, so what would be the expectation of the investor in this scenario? Any guess? Means what interest rate he can expect on his investment. The 7% is ordinary inflation, I can say. inflation. Okay. So whether he is expecting more than 7% or less than 7%. Any guess? Or exactly 7%? So whenever you are investing the money, what you expect from the borrower, or how much return you are expecting on investment? When you can say, no, I want to go with the FD, I want to go with the equity.
To receive high rate of return.
Yes, so it should be more than 7%. Okay, because if he expect the 7%, then he cannot claim any benefit over his investment. Okay, so 7% is how I can say the deposit rate, or the deposit rate, or basically it is the minimum value which supposed to be generated by the investment. Okay, so because of that reason, whenever like any party want to lend a money, any party want to keep a fixed deposit with the bank, they always expect the interest rate should be more than whatever may be the inflation rate. Then liquidity risk premium. If the asset has a more liquidity, okay, more liquidity and less liquidity. Okay, okay. More liquidity means like you can easily convert to the cash. Okay, say for term deposit. Okay, and less liquidity means you can consider the fixed asset or house property, where you expect more return. If you are investing in a term deposit, then you expect more return, or if you are investing in a house property, then you are expecting more return.
House property.
Yes, correct. Because you cannot easily convert, okay, you need to wait for a certain period, okay, so that's why your expectation for the return on investment is high in this case. And this is basically the term deposit means it is basically the security. Whenever you need a liquid cash, then you have a opportunity to convert term deposit to the liquidity. So you are okay with the less return. So here the intention of the investor is something different. Means he can park temporary amount to the term deposit. That's why he is comparing the interest rate with the zero. Otherwise, he cannot get the money. So that's why he is willing to accept a lower rate of return if he park the amount in a term deposit. Okay. But in case of the house property, whenever the investor invests in a house property, his expectation is higher than the rate of return expected in a term deposit. Okay, because that he cannot liquidate on immediate basis, or he can shift the purpose on immediate basis. So that's why he charged the liquidity risk premium. Then default risk premium that we discussed yesterday. If as an investor, if you lend money to borrower who never be in a default, okay, and then and the borrower who already in default. Okay, so when you are lending a money to person A and person B, Okay, so are you charging the same interest rate? Okay, so there is a borrower A who may not be do who may not be do any default, and borrower B who already did some default. Okay, so and if they both come and ask for a money or want to borrow the money, and you are also okay to lend the money to them, are you charging the same interest to borrower A and the borrower B?
No, sir.
Right. So borrower A, if you charge 10% interest rate, what would be the your interest rate for borrower B? More than 10 or less than 10? Or 10? I mean, it's already you told me that no same interest rate. So it is now we need to discuss whether it is more than 10 or less than 10. Sorry?
Sir, more than.
More than
More
10.
than 10.
Yeah. So again, okay, so here also, means if you lend the money to the defaulted borrower, then you expect additional premium over and above normal rate of interest. Okay, so that is basically the default risk premium. Okay, so this is basically means how we are going to calculate. Okay, normal rate of return is three, say for 3%. Okay, means if there is no interest, no inflation, no adjustment in economic situation, or the short-term interest rate is 3%, okay, then you need to add the inflation premium. So this will give the nominal interest rate. Then you need to add risk premium for interest rate, liquidity, and default risk. Default risk. Okay, so it is all together maybe 3%. So it is 8%. Okay, so why it is nominal rate of interest? It is always the difference in deposit interest rate and the lending interest rate, like this. Okay, so that's why it is a nominal rate of return, which is basically the minimum rate of return expected by the investor. Means whenever there is a zero risk, okay, so then investor is expecting 5%. Okay, the 2% already we need to add in a real rate of interest for inflation premium, and that we consider for all financial transaction. Okay, so that's why we called it as a nominal rate of return. Okay, this premium is basically irrespective of borrower. Borrower or security. Okay, and this is basically means in interest rate risk, liquidity risk, default risk is basically we need to consider the status of the borrower or status of the security. We always say we need to manage the portfolio properly. Okay, what does it mean? Can anyone explain? See, means in various investment opportunities, basically. Okay, if you see the gold or fixed deposit, they are more liquid. Okay, real estate is very less liquid or no liquid actually. Equity is also again liquid if it is listed, and debt basically it is not more liquid, not liquid, I can say. Okay, because debt instrument you may encash only on maturity. Okay, so there may be a trading of debt instrument as well, but mostly you will able to encash only on maturity. So I consider it is no liquid. Okay, so if you have a certain money, are you going to invest the entire money in one of this only one of this opportunity? If I have a
we might segregate based on the market factors.
right. So while doing an investment, what you need to keep in mind: risk, liquidity, then return. Okay. So these are the factors which we need to keep in mind. Okay. So if I put the money in a gold, okay, so I cannot predict the return. Okay, but the risk is less, and I can easily convert the asset into liquidity. In a same way, in a fixed deposit, the risk is very less, but we can predict the return, or exact return we will get it. Okay. In the real estate, it is not a liquid asset. We cannot easily convert it to the cash. Okay. But it may give the good return. Okay. More than FD. Equity, again, the same thing, have some characteristics of liquidity, but you can easily convert in liquidity. Means it is not like this, like an FD. If today's market is down, then you may not be able to sell it. Okay. And in a debt, you may get a fixed return, but you can encash only after the maturity. In case of a fixed deposit, you can liquidate premature as well. Okay. So every investment opportunity has a certain benefit and the certain issues, or certain like I can say the lacuna. Okay, so you will not get all three in a, means the less risk, more liquidity, and the more return. All three element you cannot get any single investment opportunity. So what you need to do, if you want to build a portfolio, so you need to make sure like 25% you need to invest, which give immediate liquidity. 25% you can invest in on any investment opportunity which give the stable return. Okay, 25% you can invest high return, but some liquidity benefit, and the 25% you can invest in a high return product. Okay, maybe there is no liquidity benefit. Okay, so like, can you tell me? I mean, the means if I need a liquidity, where I can invest? More focus on a liquidity.
Equity and gold.
Gold and FD, I think, because in equity also, if you invest in a private equity, then you cannot easily convert in a cash. So here the gold and FD. Second one, stable return. Any guess?
Is
FD,
it the debts?
debt as well as the FD. Yeah, FD plus debt. FD also give the stable return. High return and liquidity. Any guess?
The stock market is your fund.
Stock market, yeah, equity, gold. Okay, so both can give the high return plus to some extent liquidity. Then high return, no liquidity.
Real
Housing,
estate.
real estate, yeah, housing sector. Housing. Okay, so this what we are doing, we are trying to achieve our target by diversifying our investment in different investment opportunity. Okay, so diversification can reduce a risk, can maximize the return, okay, to some extent, and can give you the benefit of liquidity. Okay, so if it is you can diversify, that means it is unsystematic risk, which we saw yesterday. Okay, but all risk you cannot diversify. Okay, so there may be a certain non-diversifiable or systematic risk. Okay, so that is basically the diversification. Why we are doing a diversification? So that we can achieve the objective behind objective or part of the money we can utilize for particular purposes. Okay, so that is basically the benefit of diversification. If I invest entire money in a fixed deposit, okay, so I can take the benefit of liquidity and I can maintain the less risk. Okay, but I cannot maximize the return. And the same way, if I invest entire money in a housing sector, then maybe I can get the maximum return, but I cannot get the benefit of liquidity or the lesser risk. Okay, so that's why we need to diversify the investment. Okay, so that we can get the benefit of all factors like less risk, more liquidity, and more return. Okay, now we need to see how we can mitigate our risk, and we start with mitigating interest rate risk. Okay, so okay, so when you can see the interest rate risk arises, risk. Okay, so there are means if we get the loan from the bank, they may offer you fixed rate of fixed interest rate and floating interest rate. Interest rate. Are you okay to understand? Have you heard this name?
So
Okay. So
Yes, sir.
what is basically means what happened in fixed interest rate and what happened in floating interest rate?
floating interest rate fluctuates over the period of times,
Correct. And fixed
keep on increasing and decreasing. Fixed is the it's the amount which is fixed all over the term.
all over the entire period of term. Correct. Okay. Now I means I just giving one example. If the person doing a business, okay, and the person who is engaged in a job, okay. So, what is the preferences to pay the like how I can say means the person mindset to pay the interest at means what he need to consider like whether he is willing to pay fixed interest rate or whether he is willing to pay floating interest rate. I mean the businessman whether he is willing to pay the floating interest rate, and the person who is doing a job or a service whether he is willing to pay fixed interest rate. That depend on the kind of earning he has. I mean the earning opportunity he has. Okay, so businessman earning opportunity is in line with economic situation. Okay, and the job, the person who is doing a job, his earning is systematic or the stable earning. Okay, can you tell me whether the businessman willing to pay willing to pay interest with reference to the floating mechanism and or the fixed mechanism? Any guess from this situation?
Sir, floating.
Businessman is willing to pay with the floating, correct? Because his earning is also in line with the economic situation, and the interest rate increases or decreases in line with the economic situation. So his earning can manage a floating interest rate. Okay, and the same way here, the stable earning holder, he can manage fixed interest rate. Okay, but he cannot manage the floating interest rate. Means if the interest rate increases, but the job oriented person's salary is not going to increase in line with the economic situation. Okay, so that's why he is okay with the fixed interest rate, and the businessman is okay with the floating interest rate. Okay, so are you able to understand? Okay, now what happened if the businessman is able to get the cheaper interest rate when he opt for a fixed interest rate? Okay, and the same amount of loan took by job oriented person. Okay, but he got the floating interest rate. Okay, so it is risk for them. Okay, why it is a interest rate? Okay, why it is a risk? Because he expect floating interest rate, but he got the fixed interest rate, and he expect fixed interest rate, but he got the floating interest rate. So for them, changes in interest rate is a risk. Okay, for job oriented person, and for the business person, changes in earning due to the economic situation change is a risk basically. Okay, so how they can manage the risk? Are you able to understand why it is a risk when the wrong offer they got? In case of the businessman, because his income is fluctuating, but he need to pay the fixed interest rate. So it is a risk for him because his earning is fluctuating. And in the job oriented person, like his if we get the floating interest rate, means his interest rate get fluctuating even though he has a stable earning. Okay, so interest rate become the risk for businessman and the job oriented person. So how they can manage? So they can exchange the loan, means whatever the loan taken by the job oriented person, the EMI of those loan is taken care by the businessman. And the business, whatever the loan taken care by the businessman, his EMI and the interest is taken care by the job oriented person. And this mechanism we called as a swap. Okay, so that is basically the mitigating interest rate mechanism. Okay, see, businessman who has a fluctuating income, if he need to pay the fixed interest, okay, so it is a risk for him. Okay, he can pay the floating interest because interest rate get increase or decrease as per the economic situation, and the same kind of increase and decrease may happen in the earning of the businessman. Okay, in case of the job oriented person or the person or salaried employee, his income is stable over the period, so he expect or he is in better position to serve the fixed interest rate. But if he got the loan with a floating interest rate, so increase and decrease in interest rate is become the risk for him. Okay, so when this kind of situation arises, when this kind of mismatches arises, both the party come together and they decide to exchange their obligation for the interest. Okay, so for this kind of mechanism, for we called as a swap. Okay, so what they are doing, they are exchanging series of payment with each other. Okay, it is a series of payment because it is a term loan. So say for 5 years, so there is a 5 payment. Okay, then there is a 5 payment, okay, and that series get exchanged. For that we called as a swap mechanism. Okay, so this way you can mitigate the risk. Okay, second, you can enter into the forward rate agreement. Forward rate agreement. Okay, in forward rate agreement, what happened? Even though like you will get the floating interest rate and you want to opt for fixed interest rate, so you are enter into an agreement with the third party who will bear your interest. Okay, so it is, I mean, here there is a exchange of cash flow, but in this situation, if someone says, okay, so you got the loan with a 8% interest, and someone says, okay, I am okay to bear the fixed rate of interest, and I will give you the floating interest, okay, like this. So that is basically the forward rate agreement. So these are basically the mechanism where you can protect your interest rate risk. Then market risk. So what is basically the market risk and how we can protect the market risk? What is market risk?
Demand supply pricing strategies.
Mm,
A risk which every market is facing, like natural calamities, not a particular entity.
yeah. So it is market risk across industry. Okay. So how I can say, means the example of market risk is basically the prices of commodity. Okay, then you can consider the equity prices. We can take the two example. Equity prices. Okay, what is way out? Now we need to discuss what is the way out to manage the market risk. So maybe you heard derivative instrument. Okay, so these are basically the forward, future, and options. Okay, and the swap already we saw, but this is also the one of the derivative instrument. Swap. Okay. Okay. So, like whenever there is a price, we expect the prices of commodity may get increased. Okay, you can enter into the forward contract. In a forward contract, it is basically the two-way obligation. Okay, so underwriter is giving an assurance. Underwriter who giving an assurance to sell particular commodity at specific rate. Okay, so after that, whether the rate is increase or decrease, okay, so the someone is ready to sell or buy the commodity at specific rate. That is basically the forward. Okay, and the person who enter into the forward contract means the one is underwriter and the one is executor. So that is he is also under compulsion to buy or sell the commodity at a specific rate. Okay, so it is basically the two-way contract. Okay, so this way you can restrict the risk for increase or decrease in the prices of the commodity, and the same way is in equity prices. Future also the same thing, but it is a kind of systematic investment, and you can do it on a stock exchange or over the counter. Sorry, stock exchange. Yeah, stock exchange. This is forward is basically the over the counter. Over the counter means the two private parties come together and they enter into the contract. In a future, it is basically the stock exchange or exchange, not stock exchange, exchange. Okay. In options, the one party is under obligation. And the other party can enter into the contract or may resign. Or disobey, I can write. Okay, so these are basically the ways. Okay, I'll just explain, because here you just need to you do not require to understand the calculation. In a forward, it is customized contract. Okay, two parties required. Both party need to perform their obligation. Perform their obligation. Okay, this is basically the forward. So here the simple mechanism is Mr. A want to buy by 100 kg sugar at 20 rupees, or I don't know what is the sugar rate, rupees 100 per kg. Okay, and Mr. B willing to sell with the same terms. Willing to sell with same term. Okay, so here like 100 kg can become the 500. Okay, so it depend on the situation, and 100 can become the 120. Okay, so it is purely a customized contract. Okay, where both the party enter into an agreement that one person is buying a material and the second person is supplying the material. This is basically the forward contract. Okay, as this is a customized, so there is no standard quantity or price we need to maintain. Okay, and both the party need to perform their obligation. Means if tomorrow the prices goes to 120, okay, so because of that reason, I mean Mr. B, who is under obligation to sell at 100, he cannot say no. He cannot say no, and he can he is going to sell in a open market because he is getting an higher amount. That he cannot do. He need to supply to A at 100. Okay, just because in a market he is getting a 120 rate, and he can resign the contract, and he is okay to sell at a 120 in a market, that is not acceptable in a forward. So both the parties need to perform their obligation, and the reverse impact is for the when the prices are down. Means if the prices is 80, that doesn't mean the Mr. A can resign the contract and he can buy the sugar from the open market at 80 rupees per kg. that he cannot do. So both the parties are under obligation to perform their duties and to fulfill their responsibilities. So that is basically the forward. The characteristics of the forward is basically it is a customized, okay, and the agreement between the two people, and both the people need to perform their obligation. Okay. In future, the same thing, again, both the people are perform their obligation. Only difference is it is a standard contract. Okay, like if the standard says the 100 kg per contract, then he need to buy the 5 contract, okay, for 5 contract for selling or buying 500 kg, like this. So terms of the contracts are standard, okay. You cannot deviate the terms of the contract. It is across across all level. It is the same condition. Means whoever want to buy the contract, he can buy it with the same condition. Okay, so that's why if instead of 100 kg, if the Mr. A want to buy a 500 kg, then he need to purchase the 5 contract. Okay, so that's why it is a standard contract. Okay, second, can trade through exchange, not can trade. You need to compulsorily exchange through trade only. You need, it is a compulsorily you need to exchange through trade only. That has happened in a future. Okay, and the third point is again binding on both the parties. Okay, in forward there is a high default risk, that also you need to keep in mind. Okay, because it is a non-standard contract, okay, and it is enter into two private parties, it is not routed through exchange, so the chances of default is very high. In the future case, the default risk is less. Okay, why? Because the margin money kept by the exchange, okay, so may put 10%, 15% depend on the creditability of the investor or the party who enter into the contract. The margin money kept by the exchange, okay, and like the contracts are standard, so it can be easily sell or purchase over the exchange. Okay, so that's why the risk of the default is very less. Okay, so that is basically the difference in forward and future. So future is just like a forward. The only difference is it is routed through exchange, and the contract is standard. Okay. Then the third one is option. In option, underwriter is under obligation. Under obligation. But the other party can enter or cancel the contract. That is the difference. Okay, I will not explain the call put right now. Okay, there are certain other terminology that you need to understand. Okay, but basic understanding for this three opportunities are more or less same. Okay, so in under option, the underwriter is under obligation. The one party is under obligation, but the other party can enter into the contract or may cancel the contract on his will. Okay, so that is additional benefit the other party is getting. Okay, so that is that happened in case of the option. Okay, so whenever, I mean, how we are utilizing this contract or the mechanism for mitigating the market risk. When you feel that the value of the equity may increase, you can buy it today. Okay, and whenever the prices get increased, you can sell it. Okay, and you can do the reverse also. If there is a decrease in the prices, you can sell it today, and when the prices are further decreased, you can buy it again. Okay, so this way you can manage your risk. Okay, if you want to buy the investment after 6 months and if you feel the price may increase, okay, so in that situation you can enter into the forward contract or the future contract or the option, and you can lock the prices. Okay, so if the price increase more than the stated prices or the locked prices, okay, so that will not affect the investor. Okay, so that this way you can mitigate the market risk. Okay, so we can see the example of short sell. The CFO of Dillon Bank is concerned that the falling oil prices may lead to an overall stock market decline in the coming month. So in order to protect the bank investment portfolio against the market decline, the CFO opened several short position in index fund. Means what he did, short position means I'm not explaining long short. Okay, long is basically buy and short is basically sell. Okay, same way call is basically buy and put is basically sell. Okay, this word you need to keep in mind. So here the shorts means overall stock market decline. In order to protect the bank, the CFO opened several short option in an index fund because market may go down. So that's why I booked the sell entry today. When the market decline, okay, then I can repurchase and return it to exchange. Okay, so that's why we need to, and this way we can create the profit. Say for like particular equity, if I sell it today, I am able to sell at $100. Okay. Okay. So what I did, I did the short of this equity. Okay. Short means I sold it. Okay. And after 15 days, the price is 90. Okay. So then I purchase again. Okay. If I purchase at a 90, sell at 100, okay, profit with me is 10. Okay, it is a simple calculation. Okay, so this way I can mitigate the risk. Okay, so sometime we can buy the profit or mitigate the risk not by entering in the same commodity. We can enter into the other commodity as well. So as this in this example, prices of oil may decrease. So what I did, I short sell some of my investment. Okay, that I did it. Okay, so if I short sell my some of my investment, means I book the sale at a higher price. Higher price. Okay, and when the price decline, when the price sell at a higher price, when the price decline, it is basically this is the right time to repurchase, and this way I am able to gain the profit. Okay, so that is basically mitigating the market risk. But it is not so easy because you cannot correctly predict. That also you need to keep in mind. Okay. Then mitigating unsystematic risk. Unsystematic risk means a risk arises because of own action. Okay. That can be minimized or reduced by diversification. So if an investor has a broad portfolio of investment, then an event that has a negative effect on one firm, industry or investment type would have less of an effect on the value of portfolio as a whole. So I'll take a 5 names. like ABB, Tata, M&M, Infosys, and ICICI Bank. Okay, so these are basically the automotive. ABB is consumable, software, and banking. If software industry is not doing well and they grown up by 1%, okay, but the banking industry may do well and they grown up by 10%. Automotive industry is not that well, so they also grown up by 5%. And the consumable is always growing with a good margin, so they may increase by the 4%. Okay, so now you can see 5 plus 4, 9 plus 1, 10, 20. Okay, and if I add equivalent amount, so divide by 5 means the 4% is basically the my average return. Okay, if it is expected, okay, so I mean sometime I got the 10%, sometime I got the 5%, sometime I got the 4% and 1%. If it is okay, okay, the 4%, then means my portfolio is correct. Okay, here what happened, like the Infosys may gave a 1% return, that kind of mitigation I can encash by investing 10% return security. Okay, so this way we can diversify unsystematic risk. Okay, it is basically the risk associated with the particular stock, particular entity, particular industry. Okay, that you can mitigate by investing in a other industry, other stock, or other company. Okay, so this way means even though there is a 1%, but here it is 10%, so in average it is 4%, like this. Any doubt here? How we can manage the unsystematic risk? By diversifying the portfolio. Then mitigating the credit risk. Okay. So before we see mitigating the credit risk, first we need to understand what is the credit risk. Okay. So what is credit risk? If if you go with the ratings, okay, and you may get the rating of A plus plus plus, A plus plus, B, B plus, sorry, C plus plus, okay, like this. So who is able to get, who is able to get loan at a cheaper rate? Any guess?
Person which has a very high credit score.
So this one is getting a less interest rate. Okay, so credit rating inversely proportion to inversely proportion to interest rate. Okay, so person has a high credit, high credit rating can get the cheaper interest rate. Okay, so to manage proper credit rating, what we need to do?
Payment should be done on the timely basis.
Right, or no default. Okay, income Even though you have not did any default in a past, that doesn't mean you will get the loan whatever you want. Okay, so you should have a sufficient income oblique cash flow. Okay, so you should have a sufficient income oblique cash flow, leverage, capital structure, management strength, historical performance, so that you can claim the lower rate of interest. Okay, so it is income cash flow, capital structure, plus leverage, then management, after that, historical performance, and ratios. Some more factors also there, which you can see from here, the overall economic outlook, industry condition. Okay, so whatever may be the factors, if you manage properly, then you can get the loan. Okay, so the whatever may be the management of this factor, that is basically the mitigating credit risk. Then default risk. Who face the default risk actually? Borrower or lender?
Borrower.
No, borrower, lender.
Lender.
Yeah, so lender face the default risk. Okay, so for lender, borrower risk of borrower default is basically the risk. Okay, so lender face the default risk. So to manage default risk, okay, what he can do? What lender can do to manage the default risk?
Lend to higher creditworthy borrowers.
Yes. Giving short-term loans only. And he is supposed to not give entire loan to one party. Okay, may demand collateral. Means if there is a default from the borrower side, then he can sell the collateral and recover the money. Okay, so these are some of the factors which like the lender can maintain. Okay, and accordingly minimize the default risk. Then mitigating liquidity risk. So that we already discussed. If you want, like liquidity is your concern, so we saw 25% in each investment portfolio earlier. Okay, if we want a more liquid asset, then maybe you can do the 75% and 25%. Means 75% in liquidity and 25% in non-liquidity. What you are doing, you are allocating the more money. You are allocating the more money to liquid funds. Okay, so this way you can manage your liquidity risk. And then last one is the price risk. Price risk, whether the price goes up or down. So that we already saw in a market risk. The same kind of mechanism we need to apply here. I mean the forward, future, and options. Okay, if you enter in this contract, okay, you can minimize your price risk. Means the price of particular commodity whether increase or decrease. Okay, that risk you can restrict if you enter into the forward contract, future contract, and the options. Okay, any doubt here on this topic?
So
Yes.
is default risk and credit risk both are one and the same?
No.
Like,
Credit risk.
but the
Okay,
features are same, right, sir?
just a minute. Who bear the credit risk? Borrower bear the credit risk and default risk bear by the lender. So first difference is here only. Okay, so in credit risk, borrower may not get the interest rate which prevail in the market. Okay, that is basically the credit risk. Means not only the interest rate, any adverse terms which borrower is facing because of his less creditability, that is credit risk. In interest rate is only one factor. See what happened, there may be a debt covenant, okay, which is entered into by the borrower with a lender, and lender may put the stringent condition while giving a loan. Okay, so that is mainly because of credit risk of the borrower. So first thing, credit risk bear by the borrower, and the default risk bear by the lender. Okay, so he invested the money or he lent the fund to a particular borrower, but borrower may default. So that risk is associated with the lender, not with the borrower. So basic difference is credit risk bear by the borrower and the default risk bear by the lender. Are you able
Yes,
to
sir.
understand? Okay.
Yes.
Yeah. Then currency exchange risk. Okay. INR and USD. Okay. Today, one INR is equals to 8 US. Sorry, reversible. 80 INR equals to 1 USD. Okay. Tomorrow, 85 INR is equals to 1 USD. Okay. Why this happened? What are the factors?
Inflation.
No, yeah, this is one factor. Okay. So why there is a exchange rate risk? So one is inflation, other
Demand of USD is more than INR. That's why.
inflation, demand supply. Yes, I'll give one recent example actually, demand supply, which is going on right now. Demand supply, one more. Rate of return or yeah, expected return. or I can say the interest rate. Leave it expected return, interest rate. Interest rate. Okay. So first is inflation. If the inflation in particular country is high, okay. So in that situation, um, um, how I can say, like the where I mean, in a particular where the inflation is high, their value of the money goes down. Okay, so because their value of the money goes down mainly because their income consume in domestic market only. Okay, so in the country where the inflation is high, they have a very less surplus money to expense out, so that's why the value of their money goes down. Okay, so here if you see the example, assume that the US dollar is relatively stable while the Mexican peso is suffering from the sudden inflationary pressure. As the Mexican peso buys less in a domestic Mexican economy, Mexican and their banking institution seek the safe haven of the US dollar to maintain the purchasing power of their liquid resources. So demand for the US dollar created by the Mexican buying them with the Mexican peso makes the US dollar more valuable in terms of the peso. Okay, so you can understand. Say for, I'll take an India and US example. Okay, so in India, whatever the like 80 rupees is the price for $1. Okay, now what happened? Because of inflation, whatever the quantity you purchase with the 80 rupees, now you need to spend 85 rupees. But in US, the same quantity, if you purchase, say for the 10 bananas, okay, I'm just giving an example. Earlier, you can buy 10 bananas at a 80 Indian 80 rupees, but now you can buy 10 bananas at 85. In US, earlier also you can buy the 10 bananas at 1 rupee, and now also you can buy at 1 rupee. Okay, so because of inflation, now the value of 1 US dollar is 85 against previously it is 80. So this way, where means the country who are undergo the pressure of inflation, I mean their currency value get deteriorated. Okay, that is mainly because their maximum earning dispose of in a domestic market only. So they do not have a much money, much surplus money to invest or to strengthen their currency. Okay, so that's why the inflation rate affect the exchange rate. Are you able to understand? So this is because of expenses increases. The second factor is increase in income level. Increase in income level. Okay. So as So income level in United States increases significantly in the second quarter. American flock to Mexico City on vacation and to buy pintas. So this increased supply of American dollars seeking to buy pesos to purchase the Mexican good causes the value of American dollar to fall in relation to a stated number of pesos. Okay, so here basically, if like again INR and USD. So income level in the INR increases. Okay, so for earlier they are earning 10,000, now they are earning 12,000. So what they are supposed to do, whatever the additional 2000, with this 2000 they buy a US product. They buy a US product. Okay. So because of that, demand for the US currency increases. Okay. And as the demand for the US currency increases, value of the US currency also increases with respect to demand. Okay. So when the income level in one country increases, the foreign currency of the other country become more stronger. Okay. So that is basically the relative income level. In the first case, means like here inflation rate, here the expenses get increases. Okay. And because of that reason, the other countries amount or the foreign currency get strengthened. Okay. Then the government controls sometimes the tariff imposed by the government, and because of that reason exchange rate also get affected. Okay. Tariff means if you're importing something, okay, so government may put additional duty, and because of that reason like the foreign countries product become a costlier than domestic product, and demand for the domestic product get increases than foreign country product. So the same reversible effect here. Like if government impose additional tariff, okay, say for 25%, so foreign product costlier by 25%. Foreign product costlier by 25%. Okay. And because of this reason, there is a discourage of import. Okay, which leads to reduce the demand for foreign currency. Okay. So reduce the demand. If the demand for the foreign currency get reduced, the value of the foreign currency get deteriorated. Get deteriorated. Okay. So because of government intervention or government control, the value of the foreign currency also get, there is a exchange rate risk arises. Okay. So a tariff on imported pintas would have the effect of discouraging the purchase of imports and thereby reducing the demand for the peso and maintaining the exchange rate. Okay. So this way the government can control the foreign currency. Okay. So we will just revise three factors. Okay. So first factor influencing the trade factor. So where the inflation rate influences domestic market, foreign market. Okay. Now, if the inflation is high, okay, plus inflation is high, okay, then the foreign currency get strengthened. In domestic market, if the inflation is high, then the foreign currency get strengthened. Okay. income level in domestic market is high, okay, then again the foreign currency becomes strengthened, okay, and the government control. If tariff rate is high, then value of the foreign currency get reduced. Okay, so that you need to keep in mind. Expenses level or income level in the domestic market, if the domestic market is high, then the foreign currency get strengthened, and if due to the government control, if the tariff rate is high, then the foreign currency may get value of the foreign currency may get reduced. Okay, so any doubt till now? Okay, now last one, financial factors. So interest rate create demand for currency by motivating either domestic or foreign investment. So this forces to supply and demand create changes in exchange rate as investors seek fixed return. So this effect of interest rate is directly affected by the volume of capital that is allowed to flow between the countries. So like Make in India. Okay, so what happened? Uh, like lots of foreign investors invested in India, and due to this, they exchange US dollar with INR. Okay, so India is getting more US dollar, getting more US dollar. If this is the situation, okay, so US dollar get deteriorated. Deteriorated. Why? Because the demand for INR get increased. Okay. So now we can ask whatever the US dollar we want to charge against the INR. Okay. So that's why we already encourage the foreign investors to invest the money in India. Okay. So, like when the someone is investing, when the foreign entity investing in a domestic market, the value of the foreign currency get deteriorated. Okay, but right now the situation is something different. Means if you see, means as I said, I'll give one practical example. Nowadays, euro is more than 100 INR. Okay. I used to mean somewhere in 2010, it is somewhere about 60 rupees. Okay. Not 2010, somewhere 2012, it is around 60 rupees. But today it is 100 INR. Okay. The basic reason is our import is 72 million euro and export maybe the 25 million euro. Okay, so this is the last 12-month situation, I think. Okay, an actual situation. So what happened? My obligation for the country to pay in a euro is 70 million, 72 million, or I'll keep 70 million, and they can get a 25 million euro only by export. Okay, so because of that, there is a we need to buy the additional euro, which is somewhere around 45. Okay, million euro. Okay, so demand for euro get increase. So if you see the trend in last 6 months, the euro may go from 85 to 100. This is basically the situation. Okay, so these are basically the financial factors. Okay, so again, like here we can see trade related relative inflation rate, relative income level. In both the situation, if in the domestic market income level and inflation rate increase, okay, so demand for the foreign currency also get increase, and because of that reason exchange rate of the foreign currency get increase. Okay, in the financial factor, then the third one is government control. So if they restrict the import or discourage the import, okay, so in that situation the demand for foreign currency get decreased, and the rate of foreign currency also get decreased. Okay, in financial factors, relative interest rate and the capital flow. So relative interest rate means if we India is able to earn the higher interest rate. Okay, so in that, or in India interest rate is high, so in that situation also foreign currency get increased. I mean, so I'll give the example for that as well. Okay, like one USD equals to 80. In US, interest rate is 2%. And India, it is 10%. Okay. So when I invested, yeah. So after 1 year, the value of one US dollar is 1.02, and after 1 year, the value of Indian rupee is 88. Okay. So now after 1 year, 1.02 equals to 88. So what is my exchange rate as on today? 1. Okay, 86. So if the interest rate in a particular country, in a domestic country is high, then value of their currency get deteriorated. Okay, so relative interest rate and the capital flow. If there is a high capital flow in a domestic market, then the value of the domestic currency increases. If there is a negative capital flow, that as we saw in case of the Germany import and export. Okay, so in that situation, value of the domestic currency get decreases. Okay, so are you able to understand? If the interest rate in a particular country is high, then the value of currency of those country get reduced. Okay, and if there is a negative negative capital outflow, okay, negative capital flow, that means the import is more than the export. So in that situation also value of the domestic currency get decreases. Any doubt till now? Okay, so we can take a 15-minute break here. So we can rejoin at 9:50. Okay?
Okay, sir.
Yeah. Okay. So risk exposure categories. Now, see, we saw exchange rate risk. Now, why we need to bear this risk? Okay, so if any person who is doing a transaction in only in domestic currency, okay, so his receivable, okay, both are in domestic currency. Okay, so whether any change in exchange rate will affect him, any guess?
No, sir.
Yeah, because both the transaction in domestic currency, so he do not require to buy or sell the foreign currency. Okay, so any exchange rate risk will not affect his transaction. Okay, but if he enter into a transaction in a foreign currency for selling or buying any commodity or any issue in foreign currency, then definitely foreign exchange rate risk, like you need to bear foreign exchange risk currency. Okay, so if there is a transaction in foreign currency, then he need to bear the foreign exchange rate risk. Okay, so transaction exposure is one category where he need to encounter the foreign exchange rate risk. Okay, so the one example, Seattle Import Export, a US import export company, import commodity from Canada, that is pays for its Canadian dollar and export commodity to Canada, for which it receives Canadian dollar. So if Seattle Import Export anticipate that it would export 10 million dollar Canadian dollar to Canada over the next year, while importing 8 million Canadian dollar. Okay, so what is the risk basically? Means value at risk. It is in export, sorry, 10 million is export and 8 million is import. And the risk is not only associated with import, it is associated with both export and import. Means that if exchange rate is goes down, then the export proceed may affect it. There is a loss on export proceed. Okay, so that's why in a both way it is affected. Means any deviation in exchange rate will affect both export contract and import contract. So here first we need to calculate what is my value at risk, whether 18 million is value at risk, 10 million is value at risk, or 8 million is value at risk. Any guess? It is simple. I mean, you have a three option: 18 million, 10 million and 8 million. Any other option? Any guess? Okay, or you can consider the 2 million. Okay, so value at risk is basically 2 million. Why 2 million? Okay, from whatever the 10 million receivable, out of this 8 million, I do not require to convert. It is straight away apply for a import payment. Okay. So if I do not require to convert, so I do not require to face any currency gain loss risk. Okay. So it is so 8 million get compensated against the import payable. We call this mechanism as a natural hedge. Means you do not require to enter into any hedging strategy. It is straightway your import and export both having a foreign currency, so it get automatically compensated each other. Okay, so here what you are doing, out of receivable of 10 million, whatever the amount received, 8 million, that you need to apply for an import payment without converting. Okay, so that's why you do not require to encounter exchange rate risk. Okay, balance 2 million is basically the value at risk. Okay, so because that you need to convert in a domestic currency, like in US dollar in this question. So 2 million Canadian currency you need to convert in US dollar. Okay, so that's why this is basically the value at risk. Okay, if you can apply without conversion for the import payment, or then this get naturally hedged and you do not require to encounter exchange rate risk. Okay, so if the current exchange rate is $0.75 for 1 Canadian dollar, okay, and the net exposure in US dollar is 1.5 million. So 2 million Canadian dollar equals to 1.5 million US dollar. Okay. If the rate is anticipated to fluctuate 5 cents between 70 and 80, the total US dollar fluctuation exposure would be expected to be between 1.4 million to 1.6 million. Okay. So if this rate is 0.70, okay, so how much you can get? 1.4 million US dollar. Okay, so what happened if the rate goes down, then your value in a US dollar get reduced. Okay, so the Canadian currency is stronger. In that situation, US dollar, you are means after conversion from Canadian currency to US dollar, you are receiving a less US dollar. So that is loss to you. But if it is goes to 0.8, okay, so in that situation, you can get 1.6 million US dollar. So it is benefit for you. Okay, so in that situation, it is beneficial, or it is basically the gain situation, and it is basically the loss situation. Okay, so this way exchange rate affect the profit or loss while converting from foreign currency to domestic currency. That is basically the transaction exposure. If you are not converting, you are applying your receivable to payable, so then you are not encounter at any kind of risk. Okay, even though the transaction in a foreign currency, but you are going to settle in a foreign currency only. So that's why you do not require to convert, and because of that reason, exchange rate risk is not affect to this kind of transaction. So first, for entire domestic transaction, exchange rate risk is not associated. If you are able to apply receivable in a foreign currency to the payable, then again the exchange rate risk currency is not applicable. But if you are converting foreign currency in domestic currency, or converting foreign currency in domestic currency, or you are buying foreign currency through domestic currency, in that situation, the transaction in this kind of transaction, exchange rate risk is arises. Okay.
Sir?
Yeah.
But to mitigate this risk, won't there will be any contract based
Yeah,
system?
yeah. There is a forward future option. This is available. Options. Okay, same what we discussed for the commodity. In the same case, in forward also you have a bilateral contract in the future, and then there is a swap also. Okay, okay, and the option contract is available. Okay, and the swap contract means if there is a loan EMI, swap contract applies only when there is a series of payment. Forward contract, future contract, and option applies when there is a single transaction. If there is a series of transaction, then you need to go with a swap. Series of transaction means when there is a loan EMI. Okay, so this is also means there is a mitigation strategy. The same, means the same concept: forward contract, future contract, and option applies for the currency as well. Economic exposure. So, in addition to the transaction exposure, exchange rate risk is identified in a part by economic exposure. So, it is basically the potential that the present value of an organization cash inflow could increase or decrease as a result of change in exchange rate risk. So, economic exposure is generally defined through a local currency appreciation or depreciation and is measured in relation to the organization earning and cash flow. Okay. So when there is a net inflow, okay, as we already discussed the German transactions, net inflow and net outflow. So if there is a net inflow of foreign currency, domestic currency appreciate. Okay, and if there is a net outflow, domestic currency get depreciate. Now the translation exposure. Okay, translation exposure arises when the financials in a domestic currency convert to foreign currency. Okay, so means this situation arises mainly when any foreign holding company have a several subsidiaries. Okay, so like holding company, and they have a subsidiary. Okay, so holding company, they have a subsidiary. Okay, so subsidiary maintain their books of account in a local currency or domestic currency. Okay, but for consolidation purpose, in domestic currency, but for consolidation purpose, they need to convert in foreign currency. Conversion of financial. Okay, so while converting, there is a separate rule. If you apply only closing exchange rate to all P&L item and balance sheet item, so you will get the the exact financials in a foreign currency. But we generally consider average exchange rate for P&L item and and the closing exchange rate for the financial item, which is different. And because of that reason, some plug or some gap arises, and that gap is basically the translation exposure. I'll just say for like asset liability. Okay, I'll consider a single amount only. Here the 10,000 and the 10,000. Okay, and the profit number is, say, for 5,000. Okay, yeah, profit is 5,000. Okay, so what happened? So this total is 10,000. Like this. Okay, so this number get matched. Okay, now what happened if I consider the foreign currency? Okay, I'll just rewrite here. So say for the 80 is my exchange rate, so divide by 80. Divide by 80. Okay, and here also divide by 80. So balance sheet get tally easily. Okay, but there is a separate rule. For profit, you need to maintain the average exchange rate. So I consider the 75 here. Okay, and asset, particularly asset and liability also have a separate rule, but I consider at this moment the closing exchange rate. Okay, so 75 is my average exchange rate. Means when I start my year, the exchange rate is 70, and by end of the year it is 80. So I consider 75 is an average exchange rate. Okay, so if you see, because of that there is a change in balance sheet. Okay, because profit and loss item I converted with an average exchange rate, while the balance sheet item I converted with the closing exchange rate. So there is a difference in balance sheet. So whatever maybe the difference arises, that I need to consider as a translation gain or losses, like this. Okay, so here it is loss because the liability side is more than asset. Okay, so I need to accommodate this 4.16 is in asset side, or I need to reduce the profit. Okay, or the liability, I mean the profit element I need to reduce. So it is 4.16 minus I need to consider. So this is basically the translation loss. So it is a notional one. It is not the actual one. Okay, it is only arises because of conversion of financial from domestic to the reporting currency or foreign currency. Okay, so this topic we need to study in a detail. So at that time, I mean when we need to discuss, I mean whenever the detailed topic will come, at that time we will discuss in detail. But that at this moment you just need to consider, because we apply a separate exchange rate to a line item given in the financials, so that's why the difference arises, and that difference we need to consider as a translation exposure. Yeah. So here we can see the example. Domestic International Inc. has no foreign subsidiary but is deeply involved in exporting to neighborhood countries. So as there is no foreign subsidiary, so do not require to consolidate the financial with any with any subsidiary. So they need to prepare a financial only in their domestic currency. So that's why there is no translation risk. But there is a transaction. Okay, so there may be a transaction risk. So Global International Inc. has 12 foreign subsidiaries which combine make up 65% of the consolidated revenue. Okay, so domestic international has less translation exposure than global international because it has no foreign subsidiaries. Domestic international business does expose the company to exchange rate risk, however, in terms of both transaction and economic exposure. So, domestic international Inc. they deal in foreign currency for transaction purpose, but as they do not have a subsidiary, they do not require to face any translation risk. But the Global International Inc. has a 12 foreign subsidiaries, so they need to face the translation risk. So because of Global International extensive foreign operation, the parent company has a significant exposure to foreign currency translation exposure and depending on the entity's import-export activity. So Global International may also be exposed to a foreign exchange transaction and economic risk because the holding company, they may have a certain transaction with the subsidiary even though they are not exporting or importing, but sometimes they charge the management fees. Management fees is basically that subsidiary is supposed to pay some amount because the headquarter or the head office may contribute by reviewing all the operation of the domestic all the operation of the subsidiary. Okay, so because or some IT support services head office giving to all supports all subsidiaries, so they can charge some amount from the subsidiaries. Okay, and these are kind of transaction risk. Okay, so that's why they need to face foreign exchange transaction and economic risk. Okay, and along with that, the Global International Inc. may need to, because for consolidation they need to convert subsidiaries financial in the reporting currency, and because of that reason they need to absorb some translation risk as well. Okay, so that is basically the difference. So mostly while doing a consolidation with the foreign subsidiary, the every company need to absorb some translation risk. Okay, and if there is only transaction, then they need to absorb the transaction risk as well. Then location of foreign investment. Measurement of financial result of a foreign investment frequently occur in a foreign currency in which the investee company operates. The exposure of the parent company to translation risk is affected by the stability of the foreign currency in comparison to the parent domestic currency. Okay, so means the quantum how you can decide of risk. ABC company, okay, they have a two subsidiary, XYZ and PQR. Okay, so variation in the exchange rate is somewhere here 1% and here it is 10%. Okay, so where you can see the translation risk is more, like here the earlier the $1 equals to one whatever may be the currency. Okay, now it is 1.01 and here $1 is whatever may be the currency, but now it is 1.10. So where the translation risk is more. Any guess?
PQR?
PQR, yes. So as the variation in exchange rate is high, the translation risk is also high for the parent company. Okay, so like the exposure of the parent company to translation risk. This you need to understand the statement. The exposure of a parent company to translation risk is affected by the stability of the foreign currency in comparison to the parent domestic currency. So the more stable exchange rate, the lower the translation risk. More stable exchange rate, the lower the translation risk, and more volatile the exchange rate, the higher the translation risk. So that you need to understand. Translation risk we are going to see in detail. Then mitigating and controlling the transaction exposure. So it is hedging that I just gave information. Now we need to see in detail. So measuring specific net transaction exposure. So like transaction exposure, we need to calculate if we need to convert the foreign currency in domestic currency. Okay, then and only then we need to expose to the transaction risk exposure. Okay. So always net transaction exposure we need to consider, like as we saw in earlier example, receivable is 10 million, okay, and payable is 8 million. So risk is associated with only 2 million, because this out of this 10 million, 8 million we do not require to convert. That applies here. Okay, so 2 million only we need to convert. Okay, so transaction risk is associated when we are converting from domestic foreign currency to domestic currency. So to manage the risk, transaction risk, okay, so we need to enter into the hedging technique. Okay, so hedging technique, as I already informed you, it is basically the forward, future, option, and if there is a series of transaction, then swap. Okay. So, and there is a accounting mechanism. So, whenever you enter into the hedging technique, okay, you need to, it will affect your asset liability and income. It is not just like that you enter in an hedging technique, okay. So, whenever the transaction close, at that time only you are going to utilize. If there is any year-end open position, then you need to account for, okay. And that's why this will affect to asset liability and income. So you can see the example here. Worldwide Sweet Patches buys shipping center for its product from Mexico. The company incurs liability denominated in pesos that it satisfies in pesos brought with US dollar at the time of transaction settlement. The company incurs significant liability in pesos at a spot rate of $10. Worldwide management expect that the peso will strengthen to $20 by the time the bill is due and thereby double its cost. To mitigate its perceived transaction risk, the company decided to hedge its position by locking in the current peso spot rate of 0.10. Okay, so what happened? $1 US dollar, okay, equals to 100 pesos. Okay, so if the company enter into the transaction for 1 million, okay, pesos, okay, so they need to incur a liability of how much? 1000 USD? No, one more, 10,000 US dollar. Yeah, 10,000 US dollar. Okay, so this is the liability. But when the exchange rate is 0.10, but if the exchange rate is 0.20, okay, so in that situation, this liability is fixed. This liability is fixed. Okay, but now you need to spend almost 2,000 US dollar or 20,000 USD, because it is 1 million divided by 0.2. Okay, so it is 20,000 US dollar need to spend. Sorry, multiplied by, yeah. So 20,000 US dollar need to spend. So here there is a loss. Okay, to protect this loss, okay, because it is an expectation. So what the company did, they enter into the, say for option contract, okay, when the liability is due, maybe after 6 months, okay, they have a month, okay, so they have an option to buy pesos at 0.10 US dollar. Okay, so this way they can protect their liability, okay, or they can protect their loss. I mean, if they are not going to opt for a hedging option, their liability may increase from 1,000 US dollar to 2,000 US dollar. Okay, but as they enter into the option contract, okay, so they have a right to buy the pesos at ten 0.10 US dollar per peso. Okay, so this way restrict their liability. So again, they need to incur only 1,000 US dollar, sorry, 10,000 US dollar to buy 1 million pesos. Okay. Any guess? Any issue here? No. So identifying net transaction exposure. So consolidated entities consider their net transaction exposure prior to consider hedge strategies. Okay. So before going for a hedge, you should not hedge each and every transaction. Okay. You need to first evaluate what are your receivable. Okay. What are your payable in foreign currency, and then you need to net off. Okay. Like 10 million and 8 million, and only you need to go for a 2 million for hedging. So it is not like this. You need to hedge for a 10 million separately. You need to hedge for a 8 million. It is costly for you. Okay. So only the net transaction, whatever may be the net receivable or payable, that you need to hedge. One practical example I just want to share. What happened in a, like, say for US company, and they have several subsidiaries: India, Germany, Japan, and China. Okay, and all the subsidiaries are again US company also, are transaction in each other country. Okay, so like JPY, US dollar, INR. Okay, and every like China is dealing in JPY, US dollar, INR, euro. Okay, China may deal euro, so they have a receivable of 40 euro. Okay, and India may have a receivable of minus 40 euro. So most of the companies, what they are doing, they net off this transaction as well, receivable, payable. Okay, why? Even though they convert in any foreign currency, okay, there is a strategy for the internal netting as well. But even though they convert in any foreign currency, the transaction risk is very less, because here also they need to absorb the transaction risk, and here also they need to absorb the transaction risk. Okay, which get compensated each other. So that's why they means the consolidate means the treasury department and headquarter, they first knocked out all receivable, payable, and whatever may be the balance. Okay, against that only they enter into the hedging strategies. Okay, so always you need to identify the net transaction, and then the value which exposed to the conversion, and that only you need to and for that only you need to apply the hedging strategies. Then adjusting invoice policy. Okay, so that is also the case. Means there is an internal debit note, credit note. Means you should also, because for holding company it is right pocket left pocket, so that day like this 40 get knocked off against this one, and then the consolidate invoices or receivable payable decided by the US company. Okay, so international companies may hedge transaction without complex instrument by timing the payment for import with the collection from the export. Okay, so when the import, there is a due for the import payment, and at that time if there is an export receivable, then they get knocked off. Okay, or they postpone the import payment till they get the export payment in a same currency. Okay, so this way also they can manage their transaction risk. Okay. Mitigating transaction exposure, future hedge. So a future hedge entity is the holder to either purchase or sell a particular number of currency unit of a identified currency for a negotiated price on a stated date. So future hedges are denominated in a standard amount and tend to be used for a smaller transaction. Future is basically the same which we studied. Okay, so like forward, future and option. Okay, so in future we can trade in a currency. Currency in exchange. Okay, or through exchange. Through exchange. So that could be the strategy when there is a like means how this option, like if you have a payable of 1 million euro, so what you are going to do on a future, okay, you can like buy at a today's rate say for 80. Okay, you can buy at a today's rate 1 million euro at future date. Means you can like at 80 rupees you can buy the 1 million euro. Okay, 80 rupees you can buy 1 million after 6 months. Okay, now if the rate is 85, okay, so what you are going to do, I mean this payable you can settle with the 85 rate. Okay, here what you are going to do, you are buying with the 80 rate and selling this currency at 85 rate. Okay, so here you will get the profit. Okay, here you have a liability with 80, so there is a loss and that get knocked off. Okay, again try to understand. Or I will explain the reverse effect. Okay, means if the currency is dropped, your payable is 1 million and today's exchange rate is 80. Okay, then what you are going to do at future, you book 1 million euro at 80 after 6 months. After 6 months, when the due date of payable arises. Okay, now today's exchange rate is 75, say for. Okay, so you can buy the currency at 75. Okay, and you can apply here. So there is a profit. Okay, because you book the liability with 80, but now you can buy it at 75, so 5 rupees is profit. Okay, but here you need to buy at a 80 and you need to sell at a 75, so there is a 5 rupees loss. So here basically buy, no, not sell and buy, so there is a 5 rupees profit. Here buy and sell, so there is a 5 rupees loss, so this get compensated. That is basically the future mechanism. Okay, your I mean you need to, I mean so whatever maybe the profit arises here, that get compensated with a loss on a future transaction. Okay, so whatever maybe the liability you book with the 80, you are paying with the 80 only. Are you able to understand? So there are two separate transactions for the same value, whatever may be the one your enter that you need to buy, and the second your enter that you need to sell, like this. Any doubt here? We can see the example. Worldwide Sweet Peaches buys crates from Mexico. On the date, the worldwide Sweet Peaches buy crates and incurs a significant liability in pesos, and the spot rate is 0.10 US dollar. One. Okay. Because the company fears that peso will strengthen to 0.20 by the time the bill is due in 30 days, the company enters into the future contract. Okay, so that we need to solve. Will allow it to purchase the pesos needed to pay a liability of 0.10 per pesos. Okay, so what happened here? 1 peso. Okay, so here he is able to win the future. On that day, he can able to buy 0.10 at 1 pesos. So it is basically the buy. Okay. In this transaction, he purchased some material with a transaction of 0.10 US dollar for 1 pesos. Okay. So now what happened? Like whenever he want to settle his liability, he need to buy at a 0.10 dollar. Okay, because of future. Okay. Now if the rate is 0.2 for 1 pesos, means he need to spend more US dollar, so there is a loss of minus 0.10. Here he is going to buy at a adverse rate. Okay, this transaction already entered. Okay, so here he can sell this at favorable rate. Okay, so because of that reason, there is a profit of 0.10. This is original transaction, and here this is original transaction. Okay, so in both the situation, the conversion rate is 0.10 USD to 1 pesos. So there is no exchange gain and loss arises here. Okay. Whenever he need to settle the liability, he can buy from here. Okay. Like if you knock off the transaction. Okay. But you cannot settle against each other. This is not the forward contract actually. In future, you can settle through exchange only. Okay. So that's why here the buy transaction already happened. Okay. So now when the actually need to pay to the supplier, you need to buy in a market which is at 0.20, but you already enter into the future where you have where you can buy at a 0.10. So you need to buy here and you need to sell here. Okay. So here you are going to earn the profit of 0.10 and here you are going to earn the loss of 0.10. And if you knocked off both, okay, so your profit or loss is 0. Okay. So this is basically the future mechanism. Any doubt here? We can take an example. Okay. If I want to buy, and I mean the transaction, I enter into the foreign currency transaction of 1 US dollar. Okay. And the today's exchange rate is 80. So I book the purchase. I book the purchase at 80 in my books. 80. Okay. And when I want to, when I require to pay, Okay, so maybe after 3 months, so I buy the corresponding future. Future to buy. Okay, again $80, 80 INR to 1 US dollar. Okay, so that is my future. Okay, future transaction. So today I do not require to buy, but I like I have an authority or I have an privilege to get 1 US dollar at 80 after 3 months. Okay, after 3 months, actual interest actual rate is 85. Okay, so where means when I need to pay to my supplier, I need to apply the rate of 85. Means I need to buy 1 US dollar at 85. So this transaction gets settled at 85. So there is a loss of -5. Okay, how this loss I can cover here? Can anyone tell? I have a right to buy at 80. So my buy rate is 80. Whatever US dollar I have, that I can sell in an open market with 85. Okay. So 85 is my selling price and then 5 is my profit. 5 is my profit and that get compensated. Okay. So I am entering into the another transaction. Okay. With the same responsibility like this. Okay. Then account receivable application. So account receivable demonstrate in a foreign currency represent a potential transaction exposure to exchange rate risk in the event that domestic currency strengthen in relation to the foreign currency. Okay. So it is basically the Indian company. Okay. They have a receivable of AR of 100 US dollar. Okay. So today's exchange rate is 80. Okay. But then if tomorrow's exchange rate is 85, so in that situation, they're supposed to receive 8,000, but actual receipt is 8,500. Okay. So this is basically the gain situation. Okay. So here what happened? The domestic currency get weaker. Okay. If the same situation arises, weaker. Okay. If the same situation arises, 1,100 US dollar, 80, 100 US dollar, 75. Okay. So in that situation, domestic currency in strengthen. Strengthen. Okay. So it is basically the 8,000 and here receivable is 8,000 but actual receipt is 7,500. So it is minus 500 means loss. Okay. So if the domestic currency is strengthened, so in that situation we need to face a loss in case of a receivable. If the domestic currency weaker, then we face a profit in case of the receivable. Okay. And the same is reversible in case of the payable. So account receivable denominated in foreign currency represent a potential transaction exposure to exchange rate risk in the event that the domestic currency strengthen in relation to the foreign currency. In that situation, what we need to face? We need to face the loss. Should the domestic currency strengthen, less domestic currency that originally anticipated from the sale that created the receivable can be purchased with the foreign currency received and exchange loss will result. Okay. So in case of account receivable, if the domestic currency strengthen, okay, so you need to face the loss. In case of the account payable, if the domestic currency strengthen, then you need to face the profit and the reversible situation. Okay. So a future hedge contract to sell the foreign currency received in satisfaction of the receivable at a specific price at the time of account receivable is due will mitigate the risk of the strengthening domestic currency. So like the same thing. Okay. If you have a corresponding future contract, then you can make out. Means whatever the loss happened, that you can convert in the profit. What we studied for the payable. Okay, so anyone facing any difficulty on all this issue, because if you're not conceptually clear, then you may get confused while solving the MCQs. So I can repeat if required. Okay, we can see one more example. Running April International, a US-based retailer has international retail operation in several countries, including significant business in Japan. Okay, so company management expect that the Japanese retail operation will generate and liquidate a significant amount of its account receivable in 30 days. Although the current US dollar spot rate is 1 USD equals to 98.02 yuan. Company management expect the spot rate to be in 30 days. So it is 1 USD equals to 102.09. Can anyone tell whether the foreign, means this is the domestic currency and this is the foreign currency. So whether the foreign currency strengthen or appreciate, or domestic currency strengthen or appreciate with this equation?
The foreign currency appreciates, sir.
Okay, so it is basically the reversible situation. You can see earlier you can buy with 1 USD 98.02, so less number of foreign currency. But now you can buy with 1 USD a higher number of foreign currency. So that means the domestic currency get appreciate. Okay, because your lower domestic lower currency can buy the higher foreign currency, higher number of foreign currency. Okay, so that's why the domestic currency get appreciated. Okay, so now what is the situation? To mitigate the expected foreign currency loss caused by the appreciation of the US dollar, okay, the company enter into a future contract to sell an yarn at the current spot rate in 30 days, thereby locking the current value of this foreign receivable. Okay, so again the same thing. I supposed to receive the 98.02 foreign currency. My AR is 98.02. Okay, so what means when I convert this 98.02, I supposed to get 1 US dollar. Okay, but now I'm getting for this 98.02, 0.96 US dollar. US dollar. Okay. So now I can get only 0.96 US dollar. So there is a loss for US dollar. Okay. But if I enter into an, along with this receivable, I enter into an spot rate where I have a right to buy 1 US dollar at, sorry, I right to buy 90, just a minute. Okay, sell, not right, sell. 98.02 US dollar at 1 yen at 1 US dollar. Okay, this is basically the sell future. Okay, so I have a right to sell at 98.02 yuan at 1 US dollar. Okay, so what I mean, here my loss is 0.04. Okay, so what I supposed to do here, I will buy 1 US dollar through 1 US dollar 102.09 yen. Okay, and this 102.09 yen I can buy with this rate, so I am able to get 1.04 US dollar. Okay, because my sell exchange rate is 98.02. Okay, so that's why if I sell 1.0209 with this exchange rate, I can get 1.04 US dollar. So here I am buying 102.09 yen with 1 US dollar and then selling whatever may be the 102.09 yen at 1.04 US dollar, and this will give me the profit of 0.4 USD. Okay, and this get compensated. In the same thing, whatever we discuss for the payable, now it is discussed for the receivable. In payable, we need to enter into the buy future contract, means the long future contract. In receivable, we need to enter into the short future contract or the sell future contract, like this. Okay. So again, in future, what happened? I can sell 98.02 yen with 1 US dollar. Okay. As per the market, I can buy with 1 US dollar 102.09 yen. So I have a 102.09 yen, which I can sell with this ratio 98.02 equals to 1 US dollar. So by selling 102.09 yen, I can generate 1.04 US dollar. So by investing 1 US dollar, I can generate 1.04 US dollar. This will give me the profit of 0.04 US dollar, which get compensated with my transaction loss of 0.04 US dollar. Okay, so this way we can hedge the future contract. Any doubt here? Okay, so forward hedge is more or less same with the future. The only thing is that it is basically the customized solution, and means you do not require to rotate through the exchange. Okay, so forward hedge is similar to the future hedge in that entity its holder to either purchase or sell currency unit of an identified currency for a negotiated price at a future point. Although the future hedge tend to be used for a smaller transactions, forward hedge are contract between business and commercial banks and are normally larger transaction. Although a future hedge might hedge a particular transaction, a forward hedge is used based on the anticipated company need to either buy or sell foreign currency at a particular point. Okay, so it is basically future is basically for a small transaction because it is a standard contract and there is a lots of buyer and seller on an exchange. They continuously trade. Okay, so this we generally use for a smaller payable or a receivable. But the forward where the bank may be intermediary or bank may be a party, but it is one-on-one basis. It is not like this. Means you know with whom you are dealing for a forward hedge. In future, you are dealing through exchange, so you are not actually aware with whom you are dealing actually. Okay, so that is only difference. Account payable application. So account payable denominated in foreign currency represent a potential transaction exposure to the exchange rate risk in the event that the foreign currency strengthen and the domestic currency weaken. Okay, so that table we will prepare actually. Account payable. Okay, I'll talk about domestic currency only and the reverse effect you need to consider. Okay, domestic. Strengthen. If the domestic currency strengthen, so what is the impact on account payable? Profit or loss? You can give the one answer. If the domestic currency strengthen, in case of account payable, then you can buy the larger number of foreign currency with the same domestic currency or the lesser number of domestic currency. Okay, so here we will get the profit. And if it is weak, domestic currency get weak. So in case of the account payable, we need to bear the loss. In account receivable, okay, if the domestic currency is strengthened, so you, while converting the foreign receivable to the domestic currency, you will get the less domestic currency. So in case of the domestic currency, if the domestic currency is strengthened, then you need to bear the loss. And the same way, if the domestic currency is weak, then you can convert more domestic currency with the same foreign currency. So here it is a profit. Are you able to understand?
Yes, sir.
Okay.
It will get nullified, right, sir?
No, nullified when you are enter into the forward or the future transaction. If you're not enter into any hedging transaction, then whatever may be the transaction risk, okay, that you need to understand. If you're enter into the corresponding hedging transaction, then it get nullified the way we discussed right now. Okay, but if you're not entering into the hedging transaction, so what will be the impact on account payable and account receivable if domestic currency strengthen or weaken? Then you need to follow this table. Okay, so here the account payable application, it is more or less like a future transaction. So it is just we need to read. Account payable denominated in foreign currency represent a potential transaction exposure to exchange rate risk in the event that the foreign currency transaction domestic currency weaken. So in that situation, in an actual transaction, we are going to generate a profit. Sorry, loss. Domestic currency weaken. Okay, so we need to generate a loss. So forward hedge contract to buy the foreign currency at a specific price at the time of account payable are due for an entire subsidiary will mitigate this risk. Okay, so if you take a corresponding forward contract, okay, so then that loss get mitigate. Okay, the same in account receivable application. So account receivable denominated in foreign currency represent a potential transaction exposure to exchange rate risk in the event that foreign currency weaken, okay, or the domestic currency strengthen. So if the domestic currency strengthen, then we need to bear the loss on account receivable. Okay, so to mitigate this loss, we need to enter into the forward hedge contract to sell a foreign currency received in satisfaction of the receivable at a specific price at the time of account receivable are due on the monthly cycle of a particular subsidiary will mitigate the risk of strengthening the domestic currency. The mechanism is exactly the same what we studied for the future. Okay. Okay, so from here we will see in a next week. Any doubt till now? Okay, so if there is no any doubt, any question? Okay, so can we close the class?
Yes, sir.
Yeah.